Hey everyone, it is Evan here from the Trade Risk on Friday, January 11th, here with a weekend market recap video. We're going to cover all of the major markets, the current market environment, and then finish off looking at some sector analysis. So we're going to jump right into our dashboard here, take a look at what went on this week. Bulls continuing the gains to the upside. You can see some great 5-day performance numbers out of all of the major averages, up 2 to 3 to 4% or more in the Russell 2000 specifically. So some good 5-day numbers there. We closed the week pretty much flat, but we can see we did reclaim the 10 SMA. We're still below the 50 and the 200 in all the major averages, and we are above last week's highs. When we look down here at some of the individual sectors that contributed to this week's performance, it's actually sort of the perfect storm. I think it checks all the boxes of what you would want to see leading this market higher. You have biotech, you have now semiconductors, and you have the Dow transports. It's exactly what I think almost every camp of bull would want to see, and you're getting it right now. Of course, we need to keep perspective in mind, which we'll talk about in a little bit, of where we've come from and sort of the overall market structure. But generally speaking, on this rally, you're seeing risk assets and the right risk assets lead. It'd be better to see financials kind of up here as well, but 3 out of 4 is not bad. And when we look down here at the bottom two, you have staples and utilities, just as you would expect or want them to be. When we look here at the major markets, we got energy now, so oil and natural gas leading the 5-day charge. You also have emerging markets, which started to really outperformed all of December, but you're starting to see them continue in that relative strength there. And on the downside, we have safety haven TLT, and then we also have VIX here, which is certainly come off as of late. So let's jump into the charts of the S&P 500. This is the cash market weekly time frame. Each bar represents 1 week worth of trading. This is where we like to start our analysis. And again, you can see S&P 500 this week up 2.49%, and you can see it's rallying right back into the scene of the crime, where all of the real acceleration to the downside started at this 2600 level. We're getting back in to retesting this overhead supply. If you want to be a little more specific, all the way up to 2630. Depends on how tight and defined you want to draw your levels, but generally speaking, we're getting back up to overhead supply and the breakdown point. And in fact, we are now just getting back to recovering, or the highs of the week of the 21st. So remember back here, this week in December, this is where we saw the acceleration in selling, 7% down week. It took us 3 weeks now, but we did just recover all of that, and we're right back again to that week's highs. Notice we also have a curling up MACD for the past couple of weeks now in the weekly chart. We're starting to see momentum, not just continue to make new lows, but it's finally starting to turn, flatten out, and now turn up just slightly. So despite despite the 3-week, victory lap by the bulls here, we are still in a kind of structural downtrend here on the weekly time frame. We still have a series of lower highs and lower lows, and it's still generally speaking, a structure in which we do want to be cautious in and careful in, because we are still kind of heading down here and have been breaking support over the past many months now. So we do want to keep that in mind, that we are getting a rally within the context of this intermediate term downtrend, but it also matters, and it also you need to keep in mind of sort of where you live as a trader or an investor, your time frame, your time horizon, so on and so forth. So with that, let's go down to the S&P 500 daily chart. We'll switch over to the SPY ETF. We'll keep it on this board for now. It's just pretty clean. So a couple of points to make here. The first is volume. Once again, we touched upon this in last week's video, but notice here, as we continue to rally in the S&P 500, you're seeing volume just dry up. So you're seeing the rally continue on lighter volume, getting into resistance and overhead supply. Classic textbook definitions are going to tell you that that is not the ideal scenario in which you want to be aggressively purchasing new longs up here at the top end of range on declining volume in a downtrend, right? So you get a bunch of strikes against, kind of where we are right now for new exposure. But again, the path of least resistance in the short term is still higher. The trend hasn't broken. Momentum is holding up here on this daily chart, on the short term, and we haven't seen any selling pressure resume in this market yet. So as much as we may dislike the overall setup here, and I think there's general, a good amount of reasons to not like to be, heavy purchasers of new longs here, we still haven't seen on the other side, we haven't seen the sellers come back in and take this market down. So it's a bit of a wait and see moment. And, again, this is all going to be very specific on your time frame, but just be aware, we have that rising. We are been rising on the lower volume, coming into resistance, top end of a range, if you will. So let's see how that reacts. Now, there's a lot of eyes on this 260 level, right? This is not just us that is, cleverly spotting a important level in the market. I think basically everyone who's a technician, everyone who's not a technician knows we're coming back into this 2600 level. So there's a lot of eyes on here. It might not be as clean as we want it to be, even though we have kind of everything lined up here in the sense of declining volume, rallying in, we're stretched, we're coming into declining moving averages. You still got to keep in mind that we could overshoot, we could hang out here and move sideways a lot longer than the majority want. So there's a lot of paths that the market can take to frustrate the majority of us, so do keep an open mind about that. I would still love to see an overshoot of 260, get all the way up to 263s, even maybe 265. I think there's technically an open gap in here to fill. That would be great, and then a good spot to sort of roll over or just really extend for a higher probability short. But again, maybe wishful thinking. We'll see how it actually plays out next week. But we do have an inside day here on Friday. We did trade within Thursday's highs and lows, so that does set us up for perhaps some fireworks. And you have to remember that we still have earnings season coming up. That's fast approaching, right around the corner. Market may very well be another week of wait and see until we start to get more guidance and numbers out from some of those company earnings. Last but not least, here on the S&P 500, are certainly closely related, is the VIX. The VIX here this week got totally, continued to really the past 2 weeks, 3 weeks, 2.5 weeks has been, total unwind mode. We're below 20 now. So we made a high of 36. We're below 20, around 18. That's a 50% basically straight shot to the downside in VIX. Closed at 18.33 today on Friday. One interesting note, if you were to look at the VVIX, which is the volatility of volatility, if you will, the measure of demand for S&P 500 options, you can see that this is technically putting in a slightly higher low here. In other words, we kind of bottomed in the VVIX around the January the 4th, and you can see it started to perk up a little bit, starting to come back in. So even though we do see the VIX making new lows here, we're actually seeing a little more interest in these options as we start to trade at lower implied volatility, so to speak. So interesting there. And again, mean reversion traders going to be all over this, looking for some type of pop here in the VIX after a 50% straight decline. Something to keep in mind as we head into next week. So that, I think, covers most of the high level points I wanted to discuss. When we think about levels here in the SPY, again, 260 is just the obvious one. It's essentially where we broke down from. We've rallied right back into, remember, this was the highs of the FOMC meeting right in here on the 19th. This is when we had that news out. Market made that initial high all the way up around 259.40. You can see that's essentially where we've been dancing, just below that. But this 260 area, and then again, keep an eye on that open gap, which I believe is still there. Back from the 14th, and then some of these past levels in up around here. On the downside, 233 of course is sort of the ultimate low down there, but I'd be paying attention to even this 251, a little shakeout to down to retest kind of the January 4th kind of reversal day there. That'd be an interesting one. You could look at some short-term trend lines here as the slope at which this trend has been moving higher, and if we started to take out, say, Thursday's lows, that would not be a good short-term sign for the market. Might get that pullback that I think many are waiting for. So that is the S&P 500. Let's go to the IWM. This is still the bright spot for the market. You can see for the overall bull thesis here, here. We're getting close to that 145 breakdown level, but the IWM has still been resilient here. We're not seeing any cracks. Remember, this led us to the downside. It started to lead us here to the upside on this bounce. It continues to act the strongest, and we're seeing just, again, no real pressure right now in terms of selling, and I think the Russell 2000 is where you're going to want to see it show up if we're going to start to get that rollover. For now, IWM bulls continue to remain in control here. We're obviously extended all the same caveats in morning supply that we just talked about in the S&P 500, rallying to the top end of a range, extension in the short term, declining volume, into resistance, declining moving averages, etc., etc. All of those still persist. But very importantly, it hasn't meant anything yet, right? The bulls are still in control. If we look at the NASDAQ 100, you can see NASDAQ 100 here also continuing to hang on. It is, as we mentioned in our last midweek video, continues to recover the best. It is already grappling with this supply in here from October, November, December. It's not kind of retesting. I mean, it arguably is retesting the breakdown zone, but it's still positioned a little bit better here. It's recovered and is contending with some of the supply. So that's an interesting one. Take a look at the drop off of volume there. MACD has turned into positive territory, but really tough to, of course, chase this for all the reasons discussed earlier. So that is really the landscape of the overall indices. Let's go into some of the other major markets. We'll go to TLT next, and this kind of, is one of the overall points I wanted to make as well. It's interesting to note that, even though we are getting these nice rallies here in the major averages, we're 10% off the lows in the S&P 500. We really, if we're thinking about TLT, and I know there's a lot of factors here, but if we think about them as safe haven assets, as where capital flows in terms of equity turmoil, we really haven't seen them give up too much ground. And I know there's obviously a lot of other impacting forces here. It's not just the safety haven component to it, but we're really not seeing TLT give up too much of this rally that we saw over the course of December. And you can make the same comment for GLD. If you think about this as a safety haven asset, this really hasn't budged. This hasn't pulled back. So in other words, as equities have seen this strong rally, you didn't see a total breakdown and give back and similar retracement in the GLD, in the TLT. So that's curious, that's interesting, something worth pondering there. As it stands, however, TLT did run into the top end of this range. We talked about the fact that, this would be pretty stiff resistance as it was overextended to the upside into multi-month, multi-year, inflection area. And it is starting to break this short-term trend here. So it is getting a pullback. We do need to see that higher low kind of get stepped in here. Maybe the bulls step in around this 120 level. But again, not a serious pullback as of right now. But we are trying to pull back a little bit, which I think in fact is just healthy action. Go to oil next. Oil here also stabilizing, helping stabilize equity markets, frankly. Now that oil has stopped falling off a cliff, we are back to, say, the December sideways price action here. There's a ton of technical damage. This could easily bounce more, but, of course, momentum has been strong to the downside. We're getting that MACD curled up here on the weekly chart. It was up 7% this week, so very impressive, helping, again, keep equities, or the S&P at least, and energy space from falling off a cliff. It's encouraging to see. Now it's a bit of a chase here as it's off its lows, so you do have to pick your spot. Really just depends on the time frame that you're looking on and analyzing this on. But the big steep downtrend that started from the start of October has been broken, and we are starting to retrace higher. Certainly room to put in a bigger move there. If we go to natural gas, this one here right at the end of the week is starting to perk up 5.5% on Friday here to finish off. Natural gas up 3.99% on the week. We took out last week's highs. That's encouraging. This certainly did get totally deflated from its strong November run-up, so we're getting a little reversal here, a little reversion here back up into the 30 area. We talked about that as being a certainly reasonable situation, scenario, outcome for natural gas in the midweek video. Starting to see that underway, so might be some opportunity there in the long side into next week. And we go back to metals here. GLD really just hanging tough. It's not giving up the trend in the gains that it's made over the course of the past month and a half. They continue to act pretty resilient here, they being the bulls. And if we look here just at this near-term range, we're starting to tighten up. So pay attention to this next week. If you're an active shorter-term trader, look for that either continuation pattern to the upside or maybe a bigger kind of or the first sort of pullback here back into say this old channel. Silver also holding up just the same as GLD, really hasn't given up much of the gains here over the past month and a half. It certainly had that big breakout over 14. I'm liking it. I'm watching it. I'd like to get a trade in this, ideally to the long side here. So I'd welcome a small pullback or just further sideways in silver for a potential kind of continuation trade to the upside. So that I think covers everything I wanted to say on all of the major assets markets. Let's go to some of the individual sectors now. We'll sort by 5-day performance, take a look at what has helped this week, and it is biotech, which continues to put some distance in between itself and that $100 level. We've talked about $100 for quite a long time. Remember, this was the old $300 level before the split. This was tested many times. We got the quick washout, breakdown, stop run, whatever you want to label it, all the way down to 90, and we've seen a vicious rally to the upside here back into almost the midpoint of this range. So not only did we, sort of get back up here and sort of retest it or, poke our head above this $100 breakdown, is we're actually putting distance in between us. So it'll be interesting on the next pullback here, because it is quite extended in the short term, but on this next pullback, I'd love to see it come back down to that $100 level, find buyers, and then rally for a potential second leg. That's the ideal situation, but biotech 6% to the upside this week. Very impressive. Semiconductors also, remember, they started to lag a little bit last week. We mentioned that they started to slow down just a little bit, but we saw them come right back this week, 5.8%, top second relative performer on the week in terms of sectors go, and we are above now the breakdown level from December. So remember, the S&P 500 is contending with it. We're testing that 260 level from the downside right now. The semis are above that range from December, so that is encouraging to see. Similar comments to the IBB. We want to see if we get a pullback now. We would like to see the December lows hold, a higher low get put into place, so on and so forth. So good action there. And XLI, this is the industrials, seeing a nice move this week, over 4%, right back to and starting to push through the December breakdown area. This is sort of a bigger potential topping pattern that was at work here. We had quite a rally off of the lows now, almost 14%. So pretty impressive move for XLI. Again, really tough to chase, but good to see it right back and recovering the bulk of that December drop. On the downside, we got Staples. Staples here, though, really not changing a whole lot, just grinding themselves higher here. Still up on the week, 0.75%, but you can see here just kind of trying to get back some of the losses from December. Very, very steep sell-off, to say the least, over that month of December for Staples, and we're starting to, or continuing to, recover that. Utilities, same thing, kind of looking like a bear flag here in all the best fashions, but we did hold on to that $52 support, $51.50 support. We're kind of bear flagging our way up here. It'll be interesting to watch to see how that ends up resolving itself. And financials, this is the one group where I wish we had a little more performance out of it, but it is rounding out the bottom three this week. 1% gain still, but notice it just really went flat here almost all week. It hasn't gone really anywhere. That might be a fine thing if this ultimately resolves and turns into a continuation pattern. We'll have to see if that is the case next week, or if this is where things are topping out and we are about to roll right back over. That, of course, would not be a good sign for the market as a whole. So that covers now everything that I wanted to talk about for the weekly recap. Thanks so much, as always, for tuning in and watching every Tuesday and Friday. You can follow us on the Trade Risk blog or subscribe on YouTube to keep up to date with all of the latest videos. Thanks so much, as always, for watching. I really do appreciate it. Have a great weekend, and I will talk to you next Tuesday.